Welcome back to Talk Tickers, the show where we strip down the earnings calls that move the markets and figure out what the suits are actually telling us.
Yeah, we skip the press release fluff and get right to the numbers.
Exactly. And today, we're opening the hood on a consumer staple giant that just reported what might be the most confusing beat of the season.
It is definitely a head-scratcher if you only read the headlines. We're looking at Mondelez International, ticker MDLZ. They just dropped their fourth quarter and full year 2025 results.
And if you're holding this stock or even just watching the consumer staples sector, you probably have a bit of whiplash right now.
Oh, for sure.
Because on paper, this looked like a win. They beat the top line, they beat the bottom line. But the market absolutely hated it.
Hated is the right word. It was a brutal reaction for a defensive stock.
Yeah.
Mondelez closed the regular session at, what, $59.47?
Right.
But as soon as that guidance hit the wire and the call started, it just plummeted. It dropped to $56.89 since after hours.
Wow. That's a drop of over 4.3%.
Yeah, it is. And what's interesting is that traders seem to smell smoke before the fire options volume was running 2.4 times the normal average leading into this.
So the smart money was positioning for volatility. Let's unpack why. We've got a, quote, prudent guy that scared the street, a massive mismatch in cocoa hedging, and the return of a very scary word, elasticity.
It's really the perfect storm of, commodities mechanics and consumer psychology just colliding at the same time.
Okay, before we get into the drama and the hedging disaster, let's just quickly run through the scoreboard. What were the headline numbers?
Sure. Here's a snapshot. Revenue came in at $10.4 billion, which beat the consensus of $10.31 billion. That's a 9.3% year-over-year increase.
Okay, so strong top line.
Very. On the bottom line, GAAP EPS was 51 cents, but the adjusted EPS, which is what everyone really cares about, was $1.72. That beat the consensus of 70.70 cents.
Organic net revenue growth.
Plus 5.1% for the quarter.
Okay, so pause just for a second. Usually, a double beat with 5% organic growth gets you a nice little pop, or at least a flat day. This is a boring cookie company. It's not supposed to move 4% on a beat. What specifically in the guidance triggered this sell-off?
It's all about the forward-looking numbers. They're essentially telling investors to pump the brakes.
Yeah.
Hard.
How hard?
For fiscal year 2026, they guided organic net revenue growth to be flat to plus 2%.
Flat to 2, wow.
And adjusted EPS growth, flat to plus 5%.
Flat to 5%, that feels incredibly low. Mondelez usually promises, high single digits? That's sort of the unspoken contract with a stock like this.
It is. It's a huge deceleration. If you translate that, their EPS guide for 2026 is now in the range of $2.92 to $3.07.
And the street was at?
The consensus estimate was sitting at $3.13. So, they aren't just missing expectations. They are resetting the baseline significantly lower.
So great quarter in the rear view, but the windshield is foggy and the car is slowing down. Let's get into the why. This seems to all revolve around one ingredient, cocoa.
Right. This is the first segment of our deep dive, the cocoa mismatch. And to understand this call, you really have to understand the futures market over the last couple of years.
We know cocoa surged to historic highs in 2024.
It went parabolic. But here's the twist. Cocoa costs surged. So Mondelez did what any responsible company does. They hedged. They bought futures contracts to lock in prices for 2026.
Which makes sense. You lock in your costs so you can plan your pricing. That's standard operating procedure.
Correct. But in the last 2 weeks leading up to this call, literally days before they reported, cocoa prices crashed.
Wait, okay, play devil's advocate here. If cocoa prices crash, shouldn't that be good for a chocolate company?
It should be, right?
Yeah, if my input costs go down, my margins should go up. Why is the stock getting hammered?
In a perfect world, yes. But because Mondelez is a massive ocean liner, they can't turn on a dime. They are effectively locked in for 2026 at those higher pipeline costs because they hedged early.
So they're holding these contracts that say they have to pay the old high price.
Exactly. They bought insurance against high prices, and then the prices fell. They're stuck paying the premium.
Ouch.
And CFO Lucas Aramello was very open about this. He confirmed there's a one-time inventory accounting adjustment. It's going to hit them for $500 million.
Yeah.
Mostly in the first half of 2026.
$500 million. That's not a rounding error. That's a massive chunk of change.
No, it's a massive hit. And that brings us to the strategic risk, which is what really spooked investors. It's not just the accounting hit, it's the competitive exposure. The fear is, and I quote, unexpected competitive reactions.
Okay, explain that dynamic. Why do they care what the competition is doing?
Well, imagine you're a smaller competitor or maybe a private label brand. The grocery store's own chocolate chip cookies. Maybe you didn't hedge. You're buying cocoa on the spot market right now at these new lower prices.
So my cost basis is way, way lower than Mondelez's.
Exactly. So you can afford to slash the price of your chocolate bar tomorrow. You can run a promotion. Mondelez, however, is stuck.
Ah, I see. They're cornered. They either cut prices to mash you, which just destroys their margins because their costs are high,
Right.
or they keep prices high to protect margins and they lose market share to the cheap guys.
Precisely. Management basically built flexibility into that prudent guide because they genuinely don't know how irrational the competition is going to get.
So what are they telling people?
The CEO, Dirk Van de Put, he essentially said they're calling 2026 a transition year. He's telling investors to look at 2027.
The classic wait until next year defense.
In this case, it's wait 2 years. They believe 2027 is when the lower cocoa costs will finally flow through their P&L, and that's when they expect margins to really expand. But for the next 12 months, it's going to be a grind.
Okay, so the cost side is a headache, but that's only half the story. Let's look at revenue, the consumer. We kept hearing this word elasticity on the call.
Which is, the polite economic term for people stop buying your stuff when it gets too expensive.
Right. And for a long time, it felt like Mondelez had incredible pricing power. They raised prices, we kept buying Oreos, we grumbled, but we bought them. It sounds like that dynamic has finally snapped.
It has broken. We are moving from a period of pricing power to volume defense, and the numbers bear this out.
There was a stat that jumped out at me about the U.S. market.
The U.S. biscuits volume, it was down 4% in the last 3 months. That's a significant contraction for a staple category. That's just fewer packages of cookies moving off the shelf.
And the CEO described this really interesting K-shaped consumer dynamic. We hear about K-shaped recoveries in the macro economy, but it's fascinating to see it inside a grocery aisle.
Yeah, it's splitting the customer base in two. On the upper leg of the K, you have the wealthy consumers. They're doing fine.
Still buying the premium stuff.
Totally. They're still buying the better-for-you products, premium brands like Tate's Bake Shop or Perfect Bar. Those segments are growing double digits. They aren't looking at the price tag.
But the bottom leg of the K?
That's the bulk of the population. And they are value-seeking. They're trading down. They are looking for lower unit prices. And, crucially, they are shifting where they shop.
To the club stores.
To club channels. Think Costco, Sam's Club, and online, looking for deals. And Mondelez admits they are under-indexed in some of those value channels, so they are losing shoppers.
And it wasn't just the U.S., right? Europe threw them a curveball, too.
That was the big surprise of the call. Usually Europe is steady, but they saw higher than expected elasticity in Northern Europe, specifically Germany, the Nordics, and the UK.
So consumers there just hit a wall with the chocolate pricing.
It seems like it. There's a psychological ceiling on how much you'll pay for a Milka bar, and Mondelez smashed right into it.
So if raising prices off the table, what is the strategy? How do you fix the top line?
They're pivoting to what they call PPA price pack architecture.
Which is corporate speak for changing the size of the bag, isn't it?
Effectively, yes. It's the science of shrinkflation and hitting magic price points. They are adjusting pack sizes to hit specific dollar amounts. So if a $5 bar is too much, they'll shrink it and sell it for $3.99.
Keep the consumer in the franchise even if they're buying less.
Exactly. But they aren't just shrinking bags. They're increasing their working media spend significantly.
Okay, define that for us. Working versus non-working media.
Working media is the money spent on the actual ad placement, the TV spot, the digital banner. It's the cash that puts the ad in front of your eyeballs.
And non-working.
That's the agency fees, the production costs, the catering on the photo shoot. They're slashing the non-working costs to funnel every dollar into working media to drive frequency.
It sounds like a scramble for attention. So cost headwinds, consumer headwinds. Was there any good news? Any bright spots?
There were some in emerging markets. If you exclude Argentina, which is its own special case right now, the emerging markets are holding up pretty well.
Who are the stars?
Brazil and Mexico are performing very well. China and India are showing good momentum. The elasticity just hasn't hit as hard there yet.
And what about innovation? Any new breakthrough snacks?
The big play for 2026 is a major collaboration with Biscoff.
The airline cookie.
The very same. They're rolling out chocolate bars with Biscoff filling, other stuff. They're banking on that co-branding to drive some excitement. But, it's a mashup, not a new invention. It's a safe play.
I have to ask about the elephant in the room. GLP-1s. The weight loss drugs,
Never.
Ozempic, did it come up?
It did. And management was very dismissive, perhaps too dismissive. Their internal data suggests a 0.5% to 1.5% volume impact over 10 years.
10 years, that's barely a rounding error.
Correct. They view it as a non-factor for their current models. So for now, Mondelez says the Ozempic threat is completely overblown.
That's a bold stance. Okay, let's zoom out to the investor context. The stock drops 4%. We know the guidance is weak. Is this a broken company or just a broken quarter?
I think it's an execution penalty. You have to remember why people own a stock like Mondelez. They want a compounder, a stock that steadily grows year over year, rain or shine.
It's supposed to be boring and reliable.
Exactly. And the guidance they just gave says 2026 is about stabilization, not compounding. They broke that promise of consistency.
So the whole tone of the call was just cautious.
Incredibly prudent. That's the word they kept using. And it all connects to the broader sector, right? This isn't just a Mondelez problem.
No, it's a packaged snacks problem.
The whole sector is moving from a pricing year to a volume management year. The easy money from just slapping a higher price tag on the box is over.
So what are the catalysts? What should people be watching for?
Two things. First, evidence of volume stabilization in U.S. biscuits. If that negative 4% number gets worse, look out below. Second, competitive pricing wars in chocolate. Watch for deep discounts from Hershey or Mars.
And long term, they are trying to fix this cocoa supply chain issue permanently, aren't they?
They are. They're investing heavily in Ecuador and Brazil to diversify away from West Africa. And they mentioned something even more sci-fi.
The lab-grown cocoa.
Yeah, early investments in non-GMO, cell-cultured cocoa.
Chocolate from a petri dish. Wild.
Essentially, it's years away, but it shows they know the current supply chain is just unsustainable.
Fascinating. Okay, we've covered the earnings, the guidance, the strategy. Now it is time for our favorite segment.
Disclaimer time.
That's right. This is the part of the show where we pitch a trade idea. This is not financial advice. We are not your advisors. Do your own diligence. This is for entertainment only. But if we were pitching to the investment committee, what is the play?
I'm calling this one the Cocoa Time Warp Straddle.
Sounds like a sci-fi movie. Break it down for me.
Okay, the setup is this. Mondelez is eating that $500 million inventory hit in the first half of 2026. Their margins are going to look artificially compressed compared to competitors.
So the stock is in the penalty box for 2026.
Correct. But management explicitly told us that 2027 is the year margins expand significantly when the low cocoa costs finally hit their P&L. You have a predictable suppression of value, followed by a predictable explosion of value.
So how do you trade it?
It's a two-legged trade. Leg one, you fail an MDL, short MDLZ in the short term, specifically targeting Q1 and Q2 of 2026.
Right, because that's when they report the ugly hit and fight those price wars. You're betting the news gets worse before it gets better.
Exactly. You ride the negative sentiment down. But leg two is the twist.
Right.
You use the proceeds from that short to buy LAPS.
Long-term equity anticipation securities.
Yes. You buy call options dated for mid to late 2027.
So you're using the 2026 kitchen sink year to enter a long position cheaply.
It's an arbitrage on the accounting delay of commodity costs. You're betting the market is short-sighted and will panic over the 26 margins, giving you a huge discount on the 27 recovery.
I love it. You are basically shorting their accountant's diary and going long their supply chain manager's forecast.
That is the best way to put it. It's a play on time horizons. The algorithms sell the bad news, but the humans can see the good news coming.
All right, let's wrap this up. Recap the scorecard for us.
Mondelez Q4 2025. A beat on the quarter, but a really bruised outlook for 2026. The stock is down because the easy money from price hikes is over. 2026 is going to be a street fight for volume, and they're carrying a heavy backpack of expensive cocoa.
The era of just raise prices is officially dead. Now they have to actually sell more cookies.
And that is a much harder game to play.
A huge thank you to everyone listening to this deep dive. If you learned something, leave us a review. Remember, do your own research, watch those cocoa charts, and we will see you on the next one.
Stay prudent out there.